When 400 PhD economists unanimously warn of trouble ahead and urge a rate cut, does that fill you with confidence or keep you up at night? If the brightest economic minds are signaling concern, should we really believe the economy is booming? Imagine this. The Fed announces a rate cut and everybody around you, analysts, news outlets, and even your financial advisor starts to cheer. They claim it's the start of a new market rally, the dawn of economic growth, and a time to double down on your investments. But what if your enthusiasm is misplaced? What if, instead of heralding good times ahead, this rate cut is actually a sign that the Fed sees storm clouds on the horizon? Clouds that could unleash economic chaos. Those 400 brightest minds are employed by the Federal Reserve. So why are we cheering rate cuts on? We're going to challenge the status quo and explore the often overlooked reality of Fed cuts. We'll look at the historical patterns that show how rate cuts have often preceded economic downturns, not the booms most people expect. We'll break down why these cuts might not be the relief everyone is hoping for, especially when you consider the mountains of debt companies are already sitting in. In fact, far from being a remedy, rate cuts could exacerbate the underlying issues like shrinking profits and stagnant sales, especially during a recession. But we're not going to stop there. Have you noticed that interest rates have been declining even without the Fed's intervention? This isn't just a fluke, it's a sign that the economy might be in worse shape than anyone is letting on. Contrary to popular belief, lowering interest rates doesn't necessarily lead to higher inflation. In fact, in a weak economy, it might do the exact opposite. This defies the conventional wisdom that it's been drilled into us for years. And it's something you need to understand if you want to stay ahead. Now, here's where it gets really interesting. As we head into an election season, political pressure is mounting to make the economy look stronger than it actually is. But smart investors are not buying it. They're quietly moving their funds out of stocks and into long-term treasuries, a move that suggests they see trouble ahead, despite what Wall Street might be saying. This isn't just market noise, it's a strategic shift that could have huge implications. By the time you finish watching this video, you'll have a clear understanding of the risk and opportunities that lie ahead. You'll see why following the herd could be dangerous and why looking at the money supply, specifically M2, might give you a more accurate picture of what's really going on in the economy. Despite all the talk of tightening, the Fed has actually been increasing the money supply, a move that signals they're more worried about the economic downturn than they're willing to admit. And here's the kicker. While many are still debating whether a recession is coming, the truth is we are probably already in one. From rising credit card defaults to plummeting commercial real estate values, the signs are all around us. Yet official data and media reports continue to paint this rosy picture. Don't let yourself be lulled into a false sense of security. Do me a favor, hit the like button, subscribe if you're not already a member, and don't forget to engage with me. Comment below and let's have a discussion. All right, let's start by addressing a major misconception that's been fed to the public for years. The idea that the Fed cut is a surefire catalyst for a stock market boom, particularly benefiting the small cap stocks. This belief is so ingrained that whenever the Fed even hints at cutting rates, the media and analysts erupt in optimism, forecasting soaring stock prices and an economic revival. But is that really the case? Consider what happened during the 2001 recession. On January 3rd, 2001, the Fed made an unexpected decision to cut the federal funds rate by 50 basis points, bringing it down from 6.5% to 6%. This move was initially met with enthusiasm, and the stock market saw a brief rally. However, This optimism was short-lived. Over the following months, the economy continued to deteriorate and the stock market entered a prolonged downturn. By September 2001, the S&P 500 had lost nearly 20% of its value from the start of the year. The rate cuts did little to stem the tide as the underlying economic conditions continued to worsen. Fast forward to 2007-2008 financial crisis. In 2007, September, the Fed began a series of rate cuts, starting with a 50 basis point cut reduction that brought the federal funds rate down to 4.75. Once again, initial market reactions were positive, with many analysts predicting that the Fed cuts would stabilize the economy and fuel the recovery. But by the end of 2008, the global economy was in a free fall, and stock market had experienced one of its worst crashes in history. The S&P plummeted more than 38%, despite the Fed slashing rates to near zero. The reality is clear. Rate cuts could not prevent the inevitable downturn. The point is, when the Fed cuts rates, it's often a signal that the economy is in trouble, not on the brink of recovery. The idea that lower rates automatically lead to the market rally is dangerous oversimplification. History shows us that rate cuts can coincide with or even precede some of the worst economic downturns in recent memory. Let's look a little deeper into the historical evidence that contradicts the conventional wisdom around Fed rate cuts. The belief that lower rates are inherently bullish ignores the context in which these cuts are made. When the Fed decides to lower rates, it's not doing so from a position of strength. It's often a desperate attempt to stimulate a faltering economy. Look at the period leading up to the 2008 financial crisis. In the early 2000s, the Fed had aggressively cut rates to combat the economic fallout from the dot-com bubble and then the 9/11 attacks. By 2003, the federal funds rate was down to 1%, a historical low at the time. These low rates contributed to a massive housing bubble as cheap money flooded the market, leading to unsustainable lending practices and over-leveraged consumer. Sound familiar? When the bubble burst in 2007, the Fed once again turned to rate cuts, but this time the damage was too severe. The rate cuts did little to prevent the economic collapse that followed. Even more recently, during the COVID-19 pandemic, the Fed slashed rates to near zero levels in March of 2020 in response to the economic shutdowns. While the stock market initially rebounded, buoyed by unprecedented fiscal stimulus and monetary easing, the long-term effects of these cuts are still unfolding. Inflation has surged to levels not seen in decades, and the Fed is now struggling to balance the need for economic recovery with the threat of runaway inflation. The key takeaway here is the Fed cuts are not a remedy. In fact, they often come too late to address the underlying issues in the economy. Companies burdened with high levels of debt may not even benefit significantly from the lower interest rates, especially if the consumer demand is collapsing. Lower rates might reduce borrowing costs slightly, but they do nothing to fix the fundamental problems like declining sales, shrinking profits, or a weakening labor market. Furthermore, the impact of rate cuts on the broader economy can be muted if the cuts are perceived as a sign of panic rather than calculated measure. Investors may interpret aggressive rate cuts as an indication the Fed sees something ominous on the horizon, something that could trigger a deeper recession. This perception can lead to a loss of confidence, causing markets to react negatively rather than positively. While rate cuts may provide a temporary boost to the markets, they are often a sign that not all is well. The historical evidence suggests that when the Fed cuts rates, it's usually responding to significant economic weakness that rate cuts alone cannot resolve. Investors should be wary of viewing rate cuts as an automatic signal to buy, especially when the broader economic picture is deteriorating. Now, let's shift our focus to what's happening today. Interest rates have been declining, and this trend is particularly alarming because it's occurring even without direct intervention from the Federal Reserve. Historically, declining interest rates can signal a weakening economy rather than a strengthening one. This is contrary to the popular belief that lower rates always lead to higher inflation and economic growth. In 2023, despite the Fed maintaining relatively high interest rates to combat inflation, we began to see a natural decline in long-term Treasury yields. For instance, the yield on the 10-year Treasury note, which of course is a key benchmark for mortgage rates and other long-term loans, started to decrease from its peak in late 2022. By mid-2023, the 10-year Treasury yield had dropped from around 4.25% to under 3.5%, a significant decline in a short period. This decline happened without any major cuts by the Fed, suggesting that the market was anticipating a slower economy or even a potential recession. Now, it absolutely reversed course, but here we are again. The 10-year bumped up against 5% in late October of 2023, and 10 months later is receded to under 3.8%. But why is this happening? The answer lies in the broader economic indicators that are painting a less than rosy picture of the economy. Consumer spending, which accounts for roughly 70% of U.S. GDP, has shown signs of weakening. Retail sales recently jumped 1%, which has everyone thinking the consumer is doing well. This number is not inflation adjusted, and unit sales are actually down. So inflation is actually what's driving that 1% increase. Consumer spending is a clear indicator that people are tightening their belts, possibly in anticipation of a tougher economic times ahead. The labor market, which has been remarkably resilient, truth be told, through the post-pandemic recovery, is starting to show signs of cracks. Initial jobless claims have been gradually rising, with the Department of Labor reporting a steady increase over the past year. Additionally, continuing jobless claims, which track the number of people still receiving unemployment benefits after the initial claim, reached its highest level since November 2021. This uptick suggests that it's becoming harder for people to find new jobs once they've been laid off, a typical early warning sign of a broader economic slowdown. Now, let's address the misconception that lowering interest rates will automatically spur inflation. While it's true that lower rates can stimulate borrowing and spending, this only happens when the underlying economic conditions are favorable. In a weak economy, however, lowering rates may not have the desired effect. Instead, it can lead to deflationary pressures as businesses and consumers cut back on spending and investment. This is what we saw in Japan during the 1990s and 2000s, a period often referred to as the lost decade. Despite near zero interest rates and massive fiscal stimulus, Japan's economy remained stagnant for years because of weak consumer demand and excessive debt levels. We might be witnessing a similar scenario unfolding in the U.S. today. Despite the Fed's aggressive rate hikes in 2022 and early 2023 to combat inflation, the subsequent natural decline in interest rates suggests that the market is pricing in a significant economic slowdown. This defies the conventional wisdom that rates might remain high to keep inflation in check. Instead, what we're seeing is that the economy may be too weak to support higher rates, and as a result, inflationary pressures are easing on their own. What does this all mean for you? It means that the declining interest rates that we're seeing today might be a signal of a deeper economic troubles ahead. The Fed's action, or lack thereof, are often a reaction to these underlying issues rather than a solution to them. As investors and consumers, it's crucial to look beyond the headlines and understand the real economic indicators at play. If the market is already pricing in a downturn, as evidenced by declining yields and weaker economic data, it's a clear warning that the road ahead could be much bumpier than many expect. Now, let's briefly talk about the political side of things. As we approach another election cycle, it's important to recognize economic data can be manipulated or selectively highlighted to create a more favorable narrative. It's happening on both sides. It has for years. Washington has a vested interest in making the economy look strong, especially during election year. And this can lead to a disconnect between what's reported and what's actually happening on the ground. It's a strategy designed to boost confidence among voters and investors alike. But investors know better. They're not swayed by the headlines. Instead, they're paying attention to the underlying trends that aren't making the front pages. That's why we're currently seeing a quiet but significant shift among institutional investors. Many are moving their money into long-term treasury bonds, a classic safe haven asset. This shift suggests that these investors anticipate tougher economic conditions ahead, despite the optimistic tone often projected by the media and political leaders. It's a move that signals caution, not confidence, and it's a trend that's worth noting. The bottom line here is that while the public narratives might paint a rosy picture, the smart money is already positioning for what could be a rough economic period. It's essential to look beyond the surface and understand the motives behind the message being delivered. All right, let's finally talk about the money supply, specifically M2, which includes cash, checking deposits, and easily convertible near money. Monitoring the trend of money supply gives us critical insights into the Fed's real actions beyond what they publicly declare. While the Fed has been vocal about tightening monetary policy to control inflation, the reality painted by M2 data tells a much different story. Since early 2023, M2 has been on the rise, reversing from the previous year's decline. Banking, probably, maybe? This increase suggests that the Fed might be quietly injecting more liquidity into the economy in response to the underlying weakness. Despite their public stance on tightening, it's a move that indicates concern about economic slowdown, as increasing the money supply is often a tactic used to stave off a recession. This discrepancy between the Fed's rhetoric and their actions is crucial to understanding the true state of the economy. For example, during the Great Recession, similar patterns were observed when the Fed rapidly expanded the money supply to prevent a complete economic collapse. The current rise in M2 could be signaling that the Fed is once again acting preemptively to counteract economic downturns, despite what's being said publicly. This increase in money supply can have a long-term consequence, including the potential for even higher inflation down the line if the economy does rebound. But in the near term, it's more likely a sign that the Fed is bracing for economic trouble, perhaps more severe than what's being acknowledged officially. So what does this mean for you? It means that paying attention to this money supply trends is crucial, and that they can offer early warning signs that the broader market might miss. And understanding these signals can help you better navigate the economic landscape ahead. So what's the takeaway here? Fed rate cuts aren't the simple solution they're often made out to be. They're more of a signal that all is not well in the economy. As always, it's crucial to look beyond the headlines and understand the deeper trends at play. If you want to stay ahead of the curve and make informed decisions, keep an eye on the historical evidence and the real economic indicators, like money supply and long-term bond movements. As always, thanks for watching. For those of you that are first-time visitors, thanks again. Please subscribe. If you have any sort of comments or any sort of thoughts, please share them with us. Happy to respond. That's another guaranteed video, and we look forward to seeing you on the next one.